Welcome to Chapter 2, Financial Statements and Cash Flow. In Chapter 2, we will discuss the relationship between financial statements and cash flow. There are 4 types of financial statement: balance sheet, income statement, statement of cash flow, and a statement of stockholders' equity. First, let's look at balance sheet. As we discussed in Chapter 1, this is a basic equation for balance sheet. Assets equals to liability plus stockholders' equity. And the assets could be current assets, fixed assets, and the liability could be current liability and long-term liability. And stockholders' equity could be common stock or preferred stock or some other things. There are 3 things we need to pay attention on balance sheet. The first one is accounting liquidity. Accounting liquidity is about how fast the corporation can convert their assets into cash. So apparently, current assets is more liquid than fixed assets, and the accounting receivable has more liquid than inventory. The next thing we need to think about is debt and equity. Debts represent the obligation and the burden of the company because the company has to pay back in future in a certain time later. And the stockholders' equity actually is the amount assets minus liability. It represents the remaining value after the company paid all the burdens, paid all the liabilities. And the third thing we need to think is the value and cost. According to the general accepted accounting principle, all the assets should be recorded at their cost on the financial statement. And the value represents the market value. So the management job, the management purpose is to create more value than the cost. For example, if the product costs the company $1 million, the company needs to sell the product more than $1 million. For example, 1.5 million, then the company will have 5.5 million revenue. This is the balance sheet. The balance sheet represents the company's assets at a certain date. For example, at the end of the year, December 31st, excuse me. Next, let's look at income statement. Income of the corporation equals to revenue minus all the expenses which earned by the company in a certain period, usually a year, sometimes more than a year. It depends on their operation cycle. So the revenue minus expenses such as cost of goods sold, selling, general, administrative expenses, and depreciation, we got earning before income, before interest expense and tax expense. And after we subtract interest expense and tax expense, we got the net income. And net income is the figure we got after subtract all these expenses, and that is the last number on the income statement. Because the general accepted accounting principle requires that all the expenses should be recorded on a financial statement, on the income statement, at the same time as the revenue was generated. So even though some expenses is not actually happened, it's not the actual cash outflow, it should also be recorded. For example, the depreciation. Depreciation is the accountant's estimate about the cost of the equipment used in the production period. So that's just an estimation. It's not the actual money we spend on these things. So it is a non-cash item. The other non-cash item we will talk about here is deferred tax. Deferred tax is different from current tax. Current tax is the company pay the current year. Deferred tax results from the difference between the accounting income and the taxable income. That is the money the company should pay in future but it is occurred in the current period of operation. So it is also a non-cash item. So this is the two non-cash items. Then let's look at the relationship between time and cost. If the cost varies in a very short run, it is variable cost. And if the cost doesn't change in a short run, it is long term. It is fixed cost. Excuse me, that is fixed cost. But generally, in the long run, all the costs are variable cost. There's no fixed cost. And another term is called period cost. Period cost is the SG&A expenses occur in a certain period. That cost also called period cost. Okay, next let's look at taxes. The United States has one of the most complete and I think complicated tax regulations in the world. Actually, tax revenue is very important for the government. It is the main revenue of the government. In the United States, the corporation were taxed on the progressive tax rate. The lowest tax rate is 15% and the highest tax rate is 39%. And we have two concepts need to introduce here. The first one is average tax rate. Average tax rate equals to the tax liability, the tax bill we paid, divided by the taxable income. And the rate of the average tax rate range from 15% to 35%. The next concept is marginal tax rate. Marginal tax rate is if the company earned $1 more, how much, at what tax rate the corporation should pay on their income, on their taxable income. For example, if a corporation made $50,000 a year, if we look at the table, the tax rate is 15%. However, if the company make $1 more, let's see, $50,001, and then we look at the table, the company unfortunately will pay 25% on their taxable income. So that is represent the progressive tax rate. Okay, next, let's look at net working capital. We already talked about this in chapter 1. Net working capital equals to the current assets minus current liability. And the change in the net working capital is just simply use the current year's net working capital minus last year's net working capital, which is very easy to understand. Next, let's look at financial cash flow. Financial cash flow can be represented on the balance sheet equation, assets equals to liability plus stockholders' equity. And the assets part is, we can, in this financial cash flow, is the cash flow to the firm. And the right side of the equation, that is the cash flow to the investors, which is creditors and stockholders. So let's see how to calculate cash flow to the firm. Cash flow to the firm composed of three parts. The first is operating cash flow, which is equals to the earning before interest expense and the tax expense plus depreciation and minus current liability, current tax liability. And the capital spending equals to the acquisition of the fixed assets minus the sales of the fixed assets. Additions to net working capital is very simple. Just use the current year's net working capital minus last period's net working capital. And the cash flow to the investor composed of two parts. The cash flow to the creditors equals to the interest plus the retirement of the long-term debts minus the proceeds from long-term financing. And the cash flow to the stockholders equals to the dividends plus the repurchase of the stock minus the proceeds from issuing new stocks. So this is the financial cash flow. One side is about assets, the cash flow to the firm. The other side is about the cash flow to the investors from the firm. Okay. Actually, the accounting statement of cash flow is a little bit different from this financial cash flow, because the accounting statement of cash flow, their purpose is to calculate the change in cash. There are three parts in this statement. There are three activities. One is operations, one is investing activities, and the other one is financing activities. It's very simple to think in this way. If the money is if the corporation receives the money from outside, receive more money, that is a plus. If the corporation spend money, the money is a cash outflow, that is a minus. So the net income is a plus. We need to add back depreciation and deferred tax as we talked about before, because they were all non-cash items. And then we plus change in current assets and liability. If it's a positive number, we use plus. If the change is a negative number, we use a minus. Then we got the total cash flow from operations. Next, let's look at the investing activity. Investing activity is just very similar to the capital spending, but the signal is different, because the acquisition of fixed assets is a cash outflow, so this is a minus, and the sales of fixed assets increase the cash of the company, so that is a plus. Then we got the total cash flow from investing activity. The third part is financing activity. The retirement of long-term debts is a negative, it's a minus, because this is the money the company should pay back to the investors. And the proceeds from long-term debts, that is a positive, that is a plus, because that is the money came into the company. And the dividends is a minus, proceeds from new stock issues is a plus. Then we got the total cash flow from financing activity. If we add these three total numbers together, we got change in cash, and which is the number shown on the balance sheet. Okay, this is chapter 2, which is talk about cash flow and how to calculate cash flow. In chapter 3, we will talk about in a situation if we want to compare two or more companies, but they were in different industry, they have different size, it's very hard to compare them. So we will discuss some method to analyze their financial statement and to make the best financing and make the best investment decision. Thanks for watching.